How much US dollar denominated debt is outside of the US? I think it is a very important question if you are a global macro investor and worried about your savings and about this crazy global macro situation that these governments and central banks are causing. And I'll talk about why it's important in a little bit. So first off, I talked about this a year ago, almost exactly a year ago. I talked about how the dollar could act as a wrecking ball on other countries, especially emerging markets. And you can go back and listen to that live stream show in the archives. That was also around when all that crazy stuff happened with the Virginia State securities investigators too. It was random that happened then when I was talking about the dollar wrecking ball. So the dollar index, in spite of Trump announcing the tariffs, which are inflationary, which will put higher costs into the supply chain, especially for the American consumer and manufacturers, and the higher costs are passed throughout the supply chain. We had a listener who asked questions about that. And in spite of the Federal Reserve, doing its first quarter point rate cut since 2008 in over a decade, the dollar index still has held up above 98. So I think that shows on a relative basis the weakness in all the other currencies. So the dollar is not really that strong. It's just on a relative basis, the dollar just appears stronger than some of these other currencies. And that's because the European Central Bank is doing massive amounts of QE. The Fed is technically not doing QE. The Bank of Japan is doing massive amounts of QE and expanding their balance sheet. Same thing for the European Central Bank. And I took a look at the trade-weighted dollar. The Federal Reserve has not updated it post the Fed rate cuts. So the trade-weighted dollar is still at 127.8225 from July 29th. They have not updated it yet. We'll have to wait and see what happens. I guess probably by the end of next week, we should get an update. Because remember, the Federal Reserve does their own trade-weighted dollar. They invented that. So that's important to them. They monitor, in my opinion, they monitor both dollar indexes, and they have tried to prevent the dollar index from getting above 98. And in spite of Trump's tweets there about hiking tariffs on China, another 10% tariff on $300 billion worth of Chinese goods, and the Fed rate cut, the dollar index is still above 98. Now, it has not held above 98 for very long in the past, and especially in the last year. We'll have to wait and see what happens. Okay, so now let's talk about dollar-denominated debt. I get asked this question a lot. I think it's very important. So I found 6 articles, and a lot of the articles are from last year, and this is quoting the global head of sovereigns for Fitch Ratings, James McCormick. This is from an article last year. Quote, "The dollar remains the single most important consideration for emerging market finances," end quote. Quote, "A stronger dollar will be associated with a weakening of emerging market economies' external balance sheets," end quote. So borrowers weren't ignorant of the risks of a strong dollar, but for some, the allure of selling debt in dollars was too attractive to dismiss. Issuing dollar-denominated debt instead of government paper in local currencies can often result in cheaper borrowing, as risk-averse investors paid a premium for receiving interest payments in the more stable greenback. That's because volatility in emerging market currencies can wipe out the gains accrued from the high-yielding emerging market bonds. So this analyst, McCormick from Fitch, said emerging market bonds were particularly sensitive to a strengthening dollar, as it forced their central banks in those countries to drain foreign exchange reserves to halt local currencies from sliding against the buck. However, depleting those accounts means fewer dollars available for interest payments, pushing investors to demand richer yields as compensation for holding riskier debt. And this is a summary of dollar-denominated debt, and we will get to the number in a little bit, okay? I'm going to build up here. So in the 1990s, the number I found from my research, the number now, and it's staggering. In the 1990s, many countries began to accumulate large amounts of of debt denominated in US dollars. From 1990 to 2000, dollar-denominated debt tripled to 2.17 trillion from 642 billion. So I pieced together the history from different articles for you guys so you get a timeline of the massive growth of these other countries, borrowing, whether it's foreign governments, foreign banks, foreign private companies borrowing in dollars. Total issuance of US dollar denominated bonds by emerging countries doubled to more than $11 trillion between the end of 2007 and September 2017, according to the Bank for International Settlements. And the Bank for International Settlements is citing Deal Logic and other well-respected Wall Street research firms. This period between 2008 and 2017, during which the surge in foreign currency debt occurred in the emerging markets, happens to be the era of experimental monetary policies in the US, Europe, and Japan that entailed an enormous amount of money printing to artificially repress interest rates, so financial repression. And financial repression has allowed cheap debt to be issued. As interest rates were coming down, corporations and borrowers were taking advantage of this, either borrowing more or issuing cheaper debt. These experimental monetary policies had the express purpose of encouraging a debt-fueled binge of consumption and investment, so both. That is now in the past, and what remains is the hangover, the debt that these countries cannot control or inflate away. So what do the Turkish lira, the Iranian rial, the Russian ruble, the Indian rupee, the Argentine peso, the Chilean peso, the Chinese yuan, and the South African rand all have in common? It was an effective way for these countries to kickstart economic activity, and so long as their own currencies remained relatively strong against the dollar, it seemed at the time the bonds were issued fairly risk-free for them, and at least it appeared on the face, for them to issue dollar-denominated debt. What these countries have in common is that they are all on a 13-country list released by the Bank of International Settlements. Together, they constitute 62% of all dollar-denominated debt held by emerging market economies. And that dollar-denominated debt, finally, since I've been teasing the number, the Bank of International Settlements updates this quarterly. And they cite a number of different research facilities, including Deal Logic, Reuters, and others. There's a full PDF text. I'll attach you to the link. This was the best estimate I could find. So at the end of Q1 2019, US dollar credit to non-bank borrowers, so this is not including banks, outside the United States grew by 4% year on year to reach $11.8 trillion at the end of March. It grew more slowly than that to borrowers inside the United States for a third consecutive quarter. Since the great financial crisis, this is only the second period during which US dollar credit to US residents has outpaced that to non-residents. So what that means is people in other countries, especially emerging markets, are not borrowing as much dollar-denominated debt. And that would make sense because they can't afford, they're having trouble paying back the dollar-denominated debt that they already owe, and they don't want to take out any more dollar-denominated debt. And so here's something else that might be a little surprising for you. Foreign currency credit denominated in euros and Japanese yen continue to expand at a faster pace than that in US dollars. So the the euro bonds increased at 7% annual rate, and Japanese yen increased at 13%. So these other emerging markets are trying to bet on a weak euro and a weak yen. Because, like I said, these other central banks, besides the Fed, have been doing more rate cuts, more quantitative easing, more balance sheet expansion, more lowering of reserve requirements in their banks than the Federal Reserve has so far. And US dollar credit to emerging market and developing economies slowed further, growing by only 1% year on year. So basically, there is too much dollar-denominated debt outstanding, and it will be very, very tough for these emerging markets, these private sector corporations in emerging markets, these banks, private banks in emerging markets, these governments in emerging markets, to deal with the dollar-denominated debt. And as the dollar becomes stronger relative to other currencies, this dollar-denominated debt will become more onerous. And I'll explain why in a little bit. Okay, so back to I've been sampling these 6 articles. If you want to read all 6 articles in depth, I'll attach links to them after the video is over in the information section. I'm just going to read samples of most of them. So what these countries have in common is they're all on a 13-country list released by the Bank of International Settlements. Together, they constitute 62% of all dollar-denominated debt. Remember, I read a list of 1, 2, 3, 4, 5, 6, 7, 8 countries. Turkish lira, Iran, Russian ruble, Indian rupee, Argentina, Chile, China, and South Africa. So that group of 8 countries constitute 62% of all dollar-denominated of all dollar-denominated debt held by emerging market economies. That was as of 2018, towards the end of the year. Turkey was one of the most vulnerable on the list, but there are four other countries facing similar challenges: Argentina, Mexico, Chile, and Indonesia. Brazil, India, South Korea, Malaysia, Russia, and South Africa face different but related problems. The five other countries are in a better position when it comes to reserves. Though they hold larger amounts of dollar-denominated debt, they have plenty of reserves. The issue for these, and remember, Russia sold its treasury. So even though in their own internal economy they may have dollar-denominated debt, they don't own U.S. treasuries. They dumped all of them, and it didn't crash the treasury market. The issue for these countries is larger external debt. A strong U.S. dollar won't cripple these economies, but it could put enough pressure on them to compel monetary intervention. So this is some more interesting facts from last year, another article towards the end of last year. Over $200 billion of U.S. dollar-denominated bonds and loans issued by emerging market governments and companies will come due during the remainder of 2018, according to the Wall Street Journal, and about $500 billion will come due this year in 2019. They will need to be paid off or refinanced. Here is where the numbers start to get Wolf Richter of Wolf Street, who does good research for global macro and real estate markets. And also I saw a really good piece from him on financial repression recently. I think he has a podcast now too. I didn't even know he had that. Maybe I should get him on for a podcast interview. So he is saying in his article, through 2025, emerging market governments and companies face $2.7 trillion in U.S. dollar-denominated bonds and loans that will come due and have to be paid off or refinanced. This does not include euro and yen-denominated debt, of which these countries also have a large pile. Foreign currency debt becomes more burdensome if a country tries to drastically devalue its local currency. So, and this is where people who are pro-China, China bulls, will argue that China will just paper over all the debt. Well, China can do that for RMB debt. So debt that is in RMB or yuan, whichever way you want to call their currency, they can paper that over, they can bail it out, they can print it, they can hyperinflate their currency as long as they keep capital controls, and they can do bailouts in RMB debt. The problem, and you saw this with the Bank of Jinzhou and others, is the dollar-denominated debt. There is a ton of dollar-denominated debt in China. I only found one estimate that looks halfway credible so far. I am reaching out to my hedge fund contacts to get more. I will probably do another video once I get more research on this. I could only find one halfway credible estimate on this so far. I'll talk about that in a little bit. So China's problem is not RMB debt. China's problem right now is dollar-denominated debt. So they can print away, bail out, forgive their RMB debt. It's a lot easier for the People's Bank of China than the Chinese government and the large four Chinese state-owned enterprise banks to deal with RMB debt. It is very difficult for them to deal with dollar-denominated debt, because they either have to spend all their reserves, or they have to run large trade surpluses to accumulate dollars. And when the U.S. and China are in a large trade war, and the U.S. is putting on more tariffs, and China is running a current account deficit, it is a lot harder for China to accumulate those dollars, especially when they need those dollars for food and energy too, then they don't have enough dollars to spend for bailouts and to cover all this dollar-denominated debt problem that's growing. It's large and growing, and then also to buy food and energy. So let me continue then with the rest of the samples from these articles. So foreign currency debt becomes more burdensome if a country tries to drastically devalue its local currency, and this creates a vicious cycle. As this debt becomes more difficult to service, the default risk rises, and foreign currency investors are then even more inclined to stay away, leading to more capital outflows and making it nearly impossible to refinance and service that debt, thus speeding up the trip to a default. So this is where emerging market countries have gotten in trouble in the past with dollar-denominated debt. Wolf Richter just explained the cycle there. With Argentina in the past running twin deficits and having a currency peg, a dollar peg, and it fooled a lot of people, and then they were running trade deficits and other stuff, and they got in trouble with that. Okay, China's dollar-denominated debt. So this says that in 2017, Chinese companies issued a record $118.4 billion in dollar-denominated debt, more than double the amount the year before, according to data provider Dealogic. In 2018, Chinese companies had a record amount of corporate bond defaults, and 2019 has also been bad. So it looks like 2019 may be a new record from 2018. And we've seen articles in the Wall Street Journal talking about how Chinese billionaires have overexpanded, have borrowed too much, and even a few major well-respected Chinese billionaires inside mainland China are having problems and are about to default if they have not already defaulted on their debt. Probably dollar-denominated debt. I read the article from the Wall Street Journal about the Chinese billionaires. I do not remember if they specifically mentioned if it was dollar-denominated debt, but I suspect at least some of it was. Okay, so Baosheng Bank, Bank of Jinzhou, and also Chinese billionaires defaulting on debt too. A lot of the debt is dollar-denominated debt. So as the estimate that I found that was the most credible right now, without getting more information back from some of my China sources and hedge fund contacts who cover China, is from a South China Morning Post article written by Karen Young on November 16th, 2018. So this article says China is underestimating its $3 trillion debt, and this could trigger a financial crisis, says economist. So I'll read this whole article or most of it because it's important. So massive domestic debt has long been a headache for Beijing, but it is China's growing external US dollar leverage that is being underestimated, and it could possibly trigger a major financial crisis, according to Kevin Lai, chief economist for Asia, excluding Japan, at Japanese investment bank and securities brokerage Daiwa Capital Markets. China's $3 trillion debt, so that's their dollar-denominated debt, makes it especially vulnerable because of tightening U.S. dollar liquidity, the weakening yuan, and the ongoing U.S.-China trade war, said Lai. Global dollar debt outside America has risen. So this article, remember, it's over 8 months old. It was 12 trillion, so the total number outside of dollar-denominated debt outside the U.S. has dropped a little bit down to 11.8, so some of it was paid back or refinanced. And from 9 trillion in 2013. So it grew a lot from 2013. According to Lai, of that total, 25% or 3 trillion has been borrowed by China and its subsidiaries in Hong Kong, Singapore, and the Caribbean. China's US dollar cross-border claims have risen faster than any other emerging economies, despite its partially closed capital count. In response to two financial market challenges, quote, the taper tantrum in 2013, when the Federal Reserve started tightening monetary policy, an attempt by the People's Bank of China to reform the exchange rate in August 2015, China took on even more dollar debt instead of paying it down and resolving fundamental issues with corporate efficiency and governance. Quote, can this trade war push the world's dollar debt further to 13 trillion or 14 trillion? Question mark, end quote, said Lai, adding that the size of the dollar debt globally was probably peaking given U.S. dollar tightening. I don't know why I added a question mark there, probably because it's after 1 a.m. This would lead to investors selling their, and I'll also have a little bit of a workout high because I just did 60 arm curls, 60 arm curl reps without a break, 25-pound dumbbells each. Okay, this would lead to investors selling their assets to get back their dollars and paying back their dollar debt. Quote, we will be talking about a major financial crisis, a dollar debt crisis, end quote. The amount of dollar debt raised by China in its offshore centers that has entered its banking system is worrying, given the prospect of further depreciation pressure on the yuan's exchange rate, said Lai. Traders, investors, and their clients have in the past taken advantage of a lucrative spread between U.S. and Chinese interest rates to borrow cheap dollar debt and convert it into higher-yielding yuan-denominated assets. But in an effort to support lending and economic growth, the People's Bank of China has raised its rates only slightly in response to interest increases implemented by the Fed. So this was in 2018, right before the last Fed rate hike that Jerome Powell did, that almost broke the junk bond market and corporate bond market and froze new bond issuances. But the Fed still has higher interest rates than a lot of other countries and central banks. This has caused the differential between U.S. and China rates to narrow rapidly to the point where it no longer offsets the cost of paying back the external dollar debt in ever more expensive U.S. dollars. Okay, that's about the yuan exchange rate. Don't need that. As a result, dollar loans will become even more unmanageable, leading to more selling of the yuan and a possible negative spiral as the 3 trillion, quote, carry trade in dollar debt is unwound. Quote, we are talking about a huge dollar whammy. If the yuan continues to depreciate, then you will see a dollar debt crisis, end quote. So if you looked at the RMB to dollar exchange rate there, it looked like it was forming like a cup with handle and about to break out on the chart. So it looked like China's government and the People's Bank of China intervened to prevent the RMB from getting above 7, but after some a hammer down and a correction. It looks like eventually it might still rise above 7, even though the Chinese government doesn't want the exchange rate at 7, because there could be a lot of people in China panicking if the currency exchange rate gets to 7 or higher against the dollar. In a reflection of surging U.S. dollar funding costs, the 1 month, okay, that's LIBOR, skipping that. And China Evergrande Group, mainland China's most indebted property developer, is expected to be forced to pay an interest rate of as high as 11% for its planned issuance of U.S. dollar bonds, rumored to be about $1.5 billion. So this was towards the end of last year, remember the article. And so it's talking about China real estate developers that have dollar-denominated debt and having to refinance. So proceeds will be used to refinance existing loans, with analysts expecting a similar trend at other builders and tightening liquidity. Chinese developers face surging refinancing demands as $34.8 billion in onshore bonds and $17.9 billion in offshore bonds mature in the next 12 months, where their holders will have the right to demand the repayment of the bond principal, according to Moody's. And there are indications that U.S. investors may be losing interest in buying Chinese dollar bonds amid the trade war. So the Industrial and Commercial Bank of China, the country's largest lender by assets, on Wednesday postponed an offering of 3-year and 5-year dollar-denominated floating interest rate notes because of concerns about demand and pricing. So as the dollar strengthens, the dollar products that were being sold, the dollar debt that was being sold, it sounds like, by Chinese banks, that's going to stop. I'm sure it's already slowed down a lot. It may stop entirely. And more recently, actually August 2018, I found another very good article from the Nikkei Asian Review. China and emerging markets face trillion-dollar bond payments. So higher U.S. interest rates add to debt burden and hinder refinancing. Emerging markets, chiefly in China, are on the hook for about $1 trillion worth of bond redemptions per year from 2018 through 2020 as heavy post-financial crisis borrowing catches up with the debtors, and climbing U.S. interest rates will make refinancing expensive. So the interest rates are no longer climbing, but the debt is still onerous. So just because this article is about a year old, almost exactly a year old, the debt is onerous. So the interest rates, if the interest rates were going up and the dollar was strengthening, then the dollar may still strengthen even though the Fed is cutting rates. So that would be a double whammy in the past. If the interest rates were increasing by the Fed and the dollar was still strengthening, that would be a double whammy for anyone who borrowed in US dollar debt outside of the US. Okay, more crazy stuff. In the next 3 years from this more crazy stuff in this article. In the next 3 years, $3.23 trillion worth of bonds in emerging markets will mature, according to Dealogic, with corporate bonds comprising about 90% and sovereign debts around 10%. The total will hit a record $891.9 billion in 2018 and grow to $1.1 trillion in 2019 and $1.2 trillion in 2020. The roughly $1 trillion annual rate is nearly double the tally from 3 years ago. So a lot of dollar-denominated debt has been borrowed in the last 4 years. A lot. After the financial crisis of the late 2000s, central banks the world over worked to prop up economies with ample funds, supplies, and businesses and governments took advantage of low interest rates to raise funds through cheap debt. Yield-hungry investors bought up bonds, even from high-risk issuers like Greece and Argentina. But with the world now shifting toward monetary tightening, well, it's not towards tightening anymore. This was, remember, a year ago. The Fed was tightening, and the higher costs of rolling over debt are expected to create new risk for emerging markets. Chinese businesses and government entities face about, and here's the crazy part, here we go. But this was a year ago. So Chinese businesses and government entities face about $1.75 trillion, roughly 54% of the total, of bonds maturing through 2020. So that's dollar-denominated debt bonds maturing through 2020. So some of it has already matured, and that's why there was record amounts of defaults for Chinese, for issuers of Chinese companies in 2018, and there's been record defaults this year too, or on pace for record defaults, because so much dollar-denominated debt is maturing in the next couple years. The country spent about $584 billion at present rates on stimulus programs after the 2008 financial crisis, and sovereign borrowers and businesses alike went on a fundraising binge. Brazil has $136 billion of bonds, of dollar-denominated debt bonds, coming due over the 3-year period, while Russia owes $133 billion, and Mexico owes $88.1 billion. Okay, at the end of June, the debt pile for emerging market governments and businesses totaled $57 trillion, or about 30% of global debt, according to the IMF. So that was last year, and the debt is probably higher. Okay, if you want to read more of this article, I'll put the link in the information section. I think I covered it pretty well. I'll take a look and see in my notes because I summarized a lot of this. If there's anything I missed real quick. Nope, that looks like I got everything. So, summary here real quick. Thank you, Martin, for the super chat. I appreciate it. Summary real quick. There is approximately 11, according to the estimates I've seen, the Bank of International Settlements, using a number of different well-respected sources of information, 11.8 trillion in dollar-denominated debt outside the U.S. A lot of it's held by about 13 emerging markets, and a big chunk of it is from China. And we're seeing news stories come out that whether it's the Bank of Jinzhou or Baoshan Bank or private sector Chinese corporations or Chinese state-owned enterprises, there is a lot of dollar-denominated debt in China. The VIX has rallied, but that was to be expected. The trade war and the Trump comments, that's going to increase volatility. The dollar rallying is going to increase volatility. There is always attempt. Normally these VIX rallies are short though because of manipulations. So I don't know if I'd be a long-term, this is not financial advice, I don't know if I'd be a long-term holder in VIX. I have a good friend who likes to go long the VIX, and I don't think it's that good of a long-term trade. I would trade it. Not financial advice. I would trade it, and I would use volatility. I would trade volatility with puts and calls. That's just me. My personal opinion, not financial advice. So, comment if you think the dollar is going to continue to get strong. On a relative basis, it might. There is a lot of dollar-denominated debt. And by the way, after I speak to after I get some information, and I may get some really expensive hedge fund research reports sent my way in the next 24 hours, we might find out that $3 trillion number that is quoted in the South China Morning Post from the November article, that $3 trillion worth of dollar-denominated debt in China is not the real number, and it is much higher. So we'll see. Thank you for the $20 super chat, Penguin. Penguin7, I appreciate it. So the dollar, if it continues to rally on the dollar index, can do immense damage. There is a lot of dollar-denominated debt out there, and it is not easy to refinance. And the local government, the local central bank, cannot just print it away. A lot of people think they can. They can't. Oh, gold's manipulated. Gold is normally, it's been hit like on every Fed meeting. I think out of all the times I remember, it's gone up maybe 1 or 2 Fed meetings. Out of the 10 years I've been paying attention to the gold price, it almost never goes up before, during, or after a Fed meeting. The New York City Bit says the dollar is going to get real strong before it dies. It might, and we could see the dollar and gold rising together, which would surprise a lot of people because the normal correlation is if the dollar's strong, the US dollar gold price is weak. But we may see that correlation break and change. I'd have to go back and do more historical research. I was actually planning a short video on this, not a live stream show, and going back and looking for historical periods where the dollar, US dollar, and the dollar gold price actually both rise. So I was going to save that. I'll preview that now. I'll tease it a little bit. Thanks, Taylor. I appreciate it. Thanks for the kind words. So hopefully I explained to you the supply chain there. So once currency devaluations, the race to debase, central bank intervention with currencies, and then you start to see tariffs implemented, that puts ramifications through the supply chain. And it's not going to be even. So if there's a certain tariff on a certain good, it's not always going to be even. And if there's a certain currency devaluation in one currency, it's not going to guarantee that all products or services rise at a certain price based on monetary inflation. That's called the Cantillon effect. If you want to read about it on the Mises website, Richard Cantillon. A lot of his theories predate the Austrian School of Economics, and Adam Smith actually plagiarized an entire chapter of Cantillon. So Cantillon was a genius banker and speculator, and he profited handsomely riding up the bubbles of the John Laws bubble and the South Sea bubble. And then he shorted the shit out of both of them and made just enormous fortunes. And he may or may not have faked his own death. There's a lot of mystery surrounding his death. Some people think that he died in a fire in his mansion, that one of his servants killed him. And other people think that he faked his own death because he had a lot of people who wanted him dead, who hated him, and he faked his own death and escaped to South America. Cantillon is a character. One of the smartest, most underrated people in financial history. And like I said, Adam Smith in Wealth of Nations straight up plagiarized an entire chapter from Cantillon in his writing papers. Why are central banks buying gold? Because they're diversifying out of the dollar. They're hedging. They know a crisis is going to happen in the next couple of years. No one knows the exact timing, but in a couple of years. There's too much debt. There's credit bubbles. Financial repression is bad. Look at the stuff. Oh, I wanted to talk about this. Let me pull this up real quick on my phone. Hopefully that won't beep. Okay, so Brent Johnson. Everyone knows Brent Johnson. I've interviewed him recently. Santiago Capital manages money. Dollar Milkshake used to be a gold bug. He's now more measured, I would say, about gold. So he put out, one second, I'm pulling up my pictures. I took a screenshot of this. So he did a poll. Before I let you guys go, I'll talk about this. So he did a poll, and he polled almost 4,000 people. It's informal, an informal Twitter poll. Almost 4,000 people voted. So he asked, which will be the first domino to fall? And like I said, a good amount of people voted, and the choices were Europe, China, Japan, or the U.S. Emerging markets were not a vote. Otherwise, I think emerging markets might have been pretty high up there because of that dollar-denominated debt problem. And 54% of his poll said the European Union will fall first. 22% of his poll, and a lot of financial professionals and people, he's friends with a lot of people in the gold community. So a lot of financial professionals and hedge fund managers voted, and a lot of people in the gold community voted. So 54% of people said Europe will collapse first. 22% said China will collapse first. 12% said the U.S. will collapse first. And 11% said Japan will collapse first. I would have personally, if I was doing the poll, I would have put emerging markets in there, and I would have emerging markets probably ahead of China. So I would say probably European Union and then emerging markets would have a large chunk, probably a little bit less than the European Union. And then China would be probably third. I'm not sure about Japan. Japan is so complicated because they do have a lot of savings. They've incorrectly invested it, in my opinion, in Japanese government bonds. And a lot of Japanese-owned real estate there. But then the way the Japanese real estate market works on a lot of houses is they get demolished. So if you invest in a new house, the whole thing gets swiped away and rebuilt. I have a friend who moved to Japan like 20 years ago, and he told me, he wrote a book about this, and he was blogging about this. He's American. He's American, and I guess he likes Japanese culture. Japan's a complicated society. They have a lot of savings, but a lot of Japanese people, savers, have sacrificed their savings to buy Japanese government bonds. They haven't gotten any investment income. Now, if they invested that income, there are a lot of Japanese money managers and mutual funds and pension funds that buy assets outside the United States, but not all of it. So a lot of it has gone into the Japanese government bond market. They've been doing this interest rate manipulation, financial repression game longer than anyone else. Okay, so I think I covered pretty much everything. Taking a look at listener questions and comments. We're after 1 a.m., so if I screw up any grammar or make any flubs like exacerbate or something like that instead of exacerbate, then you can blame the late timing. Although I do have a lot of energy now. I did not even have a beer yet. But that's because I'm going to lift more weights later. I'm taking a break before bed. Negative coupons. Well, I think the end game, I think there's more people at the Federal Reserve that are more open now than negative interest rates and charging depositors to put money in a checking account or savings account. There's more people at the Federal Reserve that are open to that. It's also more people like Ben Bernanke's idea of zero coupon perpetuals. We'll have to see if other Federal Reserve people agree with that. And remember, there was also the research paper that came out in February from someone in the San Francisco Federal Reserve that if the Fed had gone to full negative interest rates, slightly negative interest rates, during and after the 2008 financial crisis, that the economic recovery, in air quotes, would have been faster and stronger. The government says gold is not money. The people, if they had to vote, I think people would vote that gold would be money. Or there would be certificates. So I think gold, actually paying with gold right now in the economy, you could not take a gold coin and go to a store. That would be stupid. You could get robbed and no one has change. But it could be really easy. You could have a gold certificate on your smartphone. So you would just have certificates and it would be backed by gold or silver. And the gold and silver would be audited and the reserves would be checked by the holders of the metal. I really like the certificates idea. I know, like in the past, such certificates have worked well for a certain amount of time before they went to fractional reserve certificates for gold or silver. But I think with smartphones, we could do it a lot easier. We wouldn't even have to have paper gold receipts or paper silver receipts. We could just do it on our smartphones, as long as the audits are good and the metal is checked. Yeah, I don't really have a social life right now. I have to make more money because I spoke to my accountant and I found out that this really sucks, that the Trump tax cuts don't help everyone, that because I'm self-employed, I actually owe, and I didn't make $60,000, I actually owe a larger amount of self-employment tax for Social Security than I thought. I have a $1,200 self-employed Social Security tax bill I have to pay now. Isn't that ridiculous? Thank you, Trump and his tax cuts. I've never had that in the past. Never had a bill like that. I don't owe the IRS anything. I owe the Social Security tax for being self-employed and not making at least $60,000 to benefit from the Trump tax cuts. If entrepreneurs and people who don't make $60,000 per year are getting screwed like that, it's pretty bad. You'd think there would be tax incentives for entrepreneurs to go and try to build something. It's not looking like that's happening. I think we could do real certificates better. I think there's the technology to do it better than in the past. And the paper certificates for physical gold and physical silver, they worked very, very well for a very long time. Now, there was cheating, but the market weeded that out. So any bank that tried to cheat on, go fractional reserve and issue more gold receipts or silver receipts than was actually compared to the metal in the vault, there was a bank run on that. And then that bank went out of business. And that's why you have these bankers, you have them go to the government, crying to the government for protection. Because in a free market, if they cheated like that, they would be out of business. They'd be sued. Probably in prison. Government is last millennium. Why does anyone care what government wants on a libertarian channel? Because in reality, we still have to deal with the government. Okay? Libertarians, a lot of it is just pure philosophical or theory. A lot of libertarians don't actually work in reality. So I'm trying to be more grounded and more realistic and trying to adopt to the stuff around us. I don't want to talk about my portfolio allocations. I haven't spoken to Bill. Bill's been calling me a crypto pumper, which is ridiculous because I know a lot about the gold and silver markets. I know so much I got invited up to Sprott headquarters twice. They flew me up there. I didn't pay for it. Is Exeter's pyramid BS? In a financial repression scenario, Exeter's pyramid will not be accurate with the treasury bonds part. In a financial repression scenario, the government treasuries, the government debt, and especially a lot of this corporate debt too, which is bad, should be downgraded. So Exeter's pyramid might not be accurate in a financial repression scenario. In John Exeter's defense, I think when he came up with Exeter's pyramid, there was no financial repression like that. Financial repression really started in the modern era. It started with Japan. So it's only been going... Japan was the only country doing this for the first, 20 years. And now you have the European Union, you have the US copying Japan, the European Union copying Japan, and you're going to have other countries copying Japan. I have heard from one of my China sources that if things get bad enough in China, China will do exactly what the European Union and the US and Japan are doing. That China will even go to full negative rates, and the people running things in China, the People's Bank of China and in the Chinese government, think that the worst case scenario of what can happen to China is what Japan is doing. So I would call that hubris. I would call that overconfidence. But that, according to one of my sources who actually speaks to these people in high levels of the Chinese government, that's what they expect. They expect worst case scenario is no full collapse and just Japanification and zombification, where the central bank and the government change the rules and print things over, and there's hidden stagflation and more taxes, like in Japan. That would be the worst case scenario for China. Chrono Trigger fan, that is funny. That is really funny. Hey, in a world of $87,000 per ounce gold, you're going to have to deal with expensive prices. You're not going to be rich. You may be better off than other people if the government doesn't try to take your gold with guns, or try to issue a windfall profits tax against anyone with gold, even though you did the right thing and bought gold and silver. But remember, the most important thing is rule number 1. Governments can change the rules. The biggest risk now is governments changing the rules. So you think you're set, you think you know exactly what's going to happen, and then snap your fingers, and all of a sudden the government just changed the rules. And we could get into just a silly scenario where there's new rules changes every couple weeks, even more frequent than that. First starts off maybe a couple times a year, then a couple months. Once every couple months, then it gets to weeks. We could get that silly before a hyperinflation scenario or something worse. Okay, guys. Well, I'm getting tired. I'm gonna finish the rest of my workout now and then go relax. So everyone have a great weekend, and I'll talk to you guys later. Bye.